Hey, welcome to our Friday night wealth creation course. Thank you for joining me. If you do not know me yet, we're going to fix that tonight. My name is Jerry. I'm the owner here at Wealth Dynamics. And every Friday night, we come to you live with a wealth creation course. The last 2 weeks now, we've been talking about recessions. Okay, and the reason why is we're about to have one. We're about to have one. Okay, it's going to be legit. It's going to be an opportunity. But if you're not prepared, it's not going to be an opportunity. It's going to suck, just like the last 5 did, okay? And that's going to be our topic tonight. We're actually going to take a look back at the last 5 recessions, and we're going to look at what happened, okay, what caused them, and we're going to look at would you have made money there. And depending on how you invested, maybe you would have, maybe you wouldn't. Now, to refresh really quick on last week we talked about 3 different types of assets. So we have what's called a correlating investment, meaning it goes up and down with the stock market. Okay, that's going to be like housing, stocks, mutual funds, ETFs, most financial products. We talked about non-correlating assets, meaning it does not move with the market at all. Okay, that's going to be small business equity, life settlements, some commodities. And then we talked about inversely correlating assets, which is going to be things that literally move opposite to the market. So that's going to be things like notes, bonds, sacred accounts, gold and silver, where they move backwards against the market. And if you're not positioned correctly, you're going to lose money. If you're positioned correctly, you're going to make money. That was the gist of last week, okay? And I want to go ahead and start us out with this mind track. So I want you to think about, 2008 happened, right? If you lost money in 2008 and you do the same things you did when 2008 happened and you do them again in this next recession, this is a trick question. Mike, do you think you'll make money or lose money?
In this new recession or the previous one?
In this new one, if you did the same thing you did in 2008 and lost money.
Definitely lose money.
Definitely lose money. So what does that look like? That looks like, that'd be like high home equity, right?
Correct.
You get a bunch of money in home equity like you had in 2008, you lost money, okay? What's another one? Stock market. Throw in a bunch of money in the 401k plan. You're going to lose money again. So if you lost money in the last recession and another one happens and you did the same exact thing you did last time, probably going to lose money again. Okay, very high chance of that, right? And so we want to look at what do you do to have a recession-proof investment strategy, and is that even possible? Okay, is it even possible to have a recession-proof investment? That's why we have a question mark here. Okay, we're going Anchorman. It's like, I'm Ron Burgundy. Okay, recession-proof investing. So on this first page, as always, I'm going to hit the facts with you. As you guys know, we only operate with the facts. So what is a recession? Okay, a recession is a decline in the nation's GDP for at least 6 months. Okay, GDP, who knows what that stands for?
Gross domestic product.
Gross domestic product. That's how much revenue, how much production a company's producing, right? Or a country, in our case, that's GDP. So a recession means that number went down for at least 6 months. If it did not go down for at least 6 months, it was not a recession, okay? Now, the other thing I want to point out, and this is going to throw you for a little bit of a loop, just because the country's GDP went down doesn't mean you're in a personal recession, right? So if I'm in a country where the GDP goes down, but my income went up, am I really experiencing recession?
No.
So it doesn't have to be a personal recession. Now, vice versa, okay, how many people have we seen where the recession wasn't happening in the country, the GDP was up, but their GDP was down, right? So you could already be in a recession. That's what I'm pointing out. So those of us that are like, man, the recession's coming, end of the world, like you honestly might statistically already be in a personal recession, and you're probably not going to see that much different. It's still going to suck when the recession happens because you manage your finances terribly. Okay, that's the reality. So a real recession, though, for a country is 6 months of GDP being down. If we go past 2 years, GDP being down for 2 years, that's considered a depression. Okay, GDP goes down, stays down for at least 2 years. Now we're into depression territory. Now, again, some of you guys might already be depressed. Okay, and some of you guys, when the depression happens, you're going to be doing some of the stuff we talked about, and you're not going to have an economic depression. You're going to actually see a boom with your own personal wealth because you did what the top 1% do. Okay, so check that out. That's the difference between a recession and a depression, and that's important for you to know. Now, we do have some stats showing that a recession happens every 8 to 9 years. We have not had one since 2008. Okay. Nano, I have a really hard question for you. How long ago was 2008?
We're in 2019, the 11 years.
Okay. Is 11 more than 8 or 9? 100%. Okay. So based on the fact that we have one every 8 to 9 years and we haven't had one yet, Mike, what does that tell you?
It's going to happen soon.
We're about to. Okay. We're about to have a recession. Or it's already started. You don't even know you're in it yet. Okay. It's like when you go to Olive Garden, you get the rolls before dinner comes, you're already full. Right? Right? That's the recession we're in right now. So here's the deal. Recessions used to happen because of trade influxes. So back when we were on the gold standard, a recession would happen because of trade influxes. So if my country had a lot of exports, let's say over to the Philippines, they have cows in the Philippines. Mm-hmm. Did they always?
I think so.
You sure? I'm not sure about that. I don't think so. So let's say I'm Spanish and I have a bunch of cows. Lexi's Filipino. She doesn't have cows. Okay. And I'm doing some strong trade with the Philippines. I'm sending dairy products over. They're eating them up. They're getting lactose intolerant. And then they tell me they're done. We're good on dairy. I don't have that export anymore. So I go into a recession because there's not demand for my supply. Does that make sense? That's how recessions used to happen. So it was a trade influx, a bunch of outflow, no longer needed, gets halted, slowed down, or stopped. And if you don't have another product, then you end up in a recession. That's pretty much how businesses go into recessions, right? They have a product and the product stops selling as much for whatever reason, and then the numbers go down. That's how countries used to operate as well. So if we had a recession, how would we solve a recession back in the day? We would look at what else could we export or who else could we export to? Just like a business, we would look at who else could we maybe sell our product to if we don't want to change the product, or maybe we need to get a new product and sell it to the same customer base to increase the revenue of the business and the production of that business. So that's how you would be able to be a recession proof, is you would just increase your production, or you'd move the same production over to an audience that hasn't been served yet. Now introduce the Federal Reserve, introduce the IRS, introduce fiat currency. Now recessions happen over monetary policy and market manipulation. Okay, so we talked about the milk, the Philippines, and the lactose intolerance. Okay, the next thing we're talking about is basically manipulating the numbers. So it's a totally different thing if Nano and I are making trade. What does Brazil export?
Coffee.
Okay, so Brazil could export some coffee to me. I would totally take that deal. So Brazil's exporting coffee to Jerry, okay? And Jerry's buying a bunch of the coffee. And all of a sudden, somebody messes with Jerry's finances and reduces the buying power of his dollar. All of a sudden, Jerry can't buy as much coffee from Nano because Nano is selling the same export at the same price. Jerry can't afford it anymore. Or someone messed with Nano's currency. Nano's buying power went down. Therefore, he has to sell the same coffee at a higher price. Jerry can no longer afford it, or he could just get cheaper coffee elsewhere. Now Nano's in a recession because he can't sell those goods and services anymore. That could go either way. So when a recession happens now, a lot of times it is monetary policy and manipulation of the markets. And so when we look at like the couple recessions we've had, tonight we're going to study the last 5. When we look at the last 5, we're going to see the manipulation factor. It wasn't supply and demand. It was all monetary manipulation that caused these last 5 recessions. And if you're in the financial product that's being manipulated, what's going to happen, Lexi?
Under what again?
If you're owning the product, the financial product that's being manipulated, what's going to happen?
I mean, they could control the prices.
They can control the prices. If I'm buying stock and Nano's buying stock and my stock's manipulated, I'm going to be the person that gets hit, right? I'm going to lose the money. So that's what you've got to really look at. And then the next thing is recessions are caused. Don't let anyone ever fool you into thinking that they're not caused. Okay? And this is the deal. I was watching, actually, you guys know I like picking on my boy Dave Ramsey. I saw a Dave Ramsey thing pop up the other day. He's talking about the recession, and he's talking about how, you know, everyone's screaming at recession. And he said something like the only 2 people that can be wrong all the time and still have a job are, he said, economic forecasters and weather people. And that was kind of his joke. And he's like, well, the recession's not going to happen. And if it does, normal people aren't going to feel it. They're just going to go back to work. Okay. Well, let me ask you, how are you going to go back to work if you were one of the people that lost their job? Like in 2008, it wasn't a joke. Like people lost jobs, people lost homes, people lost retirement plans. Even the ones that had the 12% growth stock mutual funds in it, they lost those. Okay. So it's not going to be just you go back to work and pretend it's not happening. Those are all the myths that we talked about last time. And we're going to jump into some of those again. So here are some of the myths on a recession. The recession myth is the first one is that anytime there's a crash, it's a recession. That's a myth. Okay. We see people all the time whenever a crash happens. It's a recession. What's the definition of recession, Mike?
It has to be 6 months, at least 6 months of
a downstat GDP. So if the market crashed, does that necessarily mean it's a recession? No, the real stat is what's the GDP. Okay, and just because the GDP is down doesn't mean it's a recession for me. I might not feel that. So again, that's a myth. So the idea that just because it crashed means that it's a recession, that's not true. And that's an attitude that you have to get out of. A lot of times that's media and press. The news, they sell news. So they're going to sell you the story of the market crashed and we're in a recession. Really, you got to watch the GDP. The next one is the best way to get through a recession is to continue business as usual. Okay, that's the myth that we're talking about now. That's like Dave saying the normal people, they just go back to work and they're not going to feel it. Okay, so we know that in an emergency, you don't just continue business as usual. You promote and you produce. You increase the number of if you're in sales, the number of calls you're making, okay? If you're in business, the amount of revenue you're bringing in. If you're a country, the amount of GDP you're bringing in. You've got to focus on how do I increase my production. Okay, so that's a myth. Now, if our GDP is down, let me ask you, does making money cheaper really help?
No.
If the production of goods and services being sold is down, does making money cheaper, does lowering interest rates even help? No, that's how Enron went out of business. You can't just buy more of your own product. I've actually got to increase production, which means there has to be some sort of push to get the production there, which comes from organizing, producing, and routing, right? So if we're trying to break through a recession, we can't just continue business as usual. That's a cute sentiment, but it's not true. Next one, in a recession, you need to cut back. Okay, that's a myth as well. The idea that in a recession, the first thing you need to do, you need to cut back. You need to budget harder. You need to not spend any money. And the reality is if you cut back, you're actually shooting yourself in the foot. If you're getting beat and you decide to retreat, and I know that rhymed, that was unintentional, you're going to get killed. Okay, the idea in a recession is you actually have to charge and attack, not cut back. Next one is there's no way out of the recession. If you're in a recession, you're just in it and you've just got to hunker down and you've got to suffer and hope your 401k comes back and just wait it out. And there's no way to avoid the recession and everyone's going to lose money and it's just part of the system. That's also a myth, guys. That's sold to you by gloom and doom, politicians, news media. It doesn't matter if you're a Democrat and you like NBC or you're a Republican and you like Fox. They're both wrong. Okay. The idea behind this is they keep you scared and consuming more of their product. There is a way out and people make money in recessions all the time. Next one is that you can't make money in a recession. Who's ever heard that? Okay, I can't, economy, business isn't doing well, sales are down, things are slow. That's what we hear all the time. We hear it in Alaska with seasons. Oh, it's summertime, people are too busy, they're not going to do it. Or, oh, it's winter time, now people are just out snow machining, they're not going to do it. That's not a real excuse. So you can make money during a recession, and we're going to talk about how to do that. And then finally, is that during a recession, your investments have to crash, and the only solution is for you to buy low and wait. Who's heard that one? Your investments are going to go down and just buy more of them because they're on sale, and you're going to wait it out. Those are all myths of the recession. And I want you to look at, as we're going through tonight, again, we're going to look at the last 5 recessions. I want you to think about each and every one of these myths and how it would have panned out in any of the last 5 recessions. Okay, if you would have just, considered every crash a recession. Because in the last 20-something years, I think we're going to go over about 29 years of history, there were only 5 recessions. Okay, there were more than 5 market crashes, but there were only 5 recessions. So if you lived by that rule, what would have happened? Or if you lived by just continue business as usual, what would have happened?
29 years, 5 recessions.
Yep, in 29 years, there's only been 5 recessions.
That's an average of
Every 5.8 years in the last 29 years. Okay. So based on the 29-year cycle, what Nano's getting at is we should have 2 already. Yeah. Okay. We should have already had 2 recessions. So here's the truth, guys. We already hit this. A market crash is not a recession. It's a decrease in GDP for more than 6 months. You cannot get through recessions with business as usual. You've got to push harder and increase production. And then here's the one that most people don't realize. Cutting back during a recession actually leaves you smaller than you started. Okay, if you're fighting in a recession, you're trying to increase your revenue, you're trying to build wealth, and instead you cut back and contract, you're going to leave that recession smaller than you went in. And you're not going to have ground to expand with. You're going to have to do twice as much work. And this is the same principle as, if I'm losing and I retreat or I give up or I surrender. Okay, I've never been attacked by a bear up here, but I've always called bullshit on the people that said pretend like you're sleeping or you're dead. Like that to me doesn't seem like an excellent strategy. I would rather fight the bear. Maybe I die, but at least I fought the bear, right? The recession, I don't want to just lay there and let it beat me up and drag me all over the place and retreat and hope that I actually make it through, because I'm actually going to lose some limbs. Okay, I'm going to come out a lot smaller than where I started. And then lastly here, when people say that you just have to hunker down and you can't get out of it, the way out of a recession is actually to go into it. Okay, you actually lean into the things that are going down. You lean into the recession rather than pulling back away from it. And then reality is, guys, if you study the top 1%, people build wealth in recessions every single time. Okay, if it's happening every single time and it's the same people doing it every single time, what does that tell you? They're savages, but it tells you they have a very effective plan. If it's every single time, if I told you I had a 100% batting average over the last 200 years economically, you would start to wonder, what is Jerry doing, right? Why is he always winning in a recession? The top 1% did that. We looked at that chart last week where it showed literally, figuratively, or not figuratively, literally with figures and facts, every single recession and depression, they stopped saving, they bought everything, and they increased their saving as soon as they bought everything. And it's not a figurative thing. It's not like, most of the time. We looked at statistically, it happened like clockwork on every single recession. Almost to the degree where you start wondering, are they causing that? Do they want it to drop so they can go buy everything? And then finally, you don't have to lose money in a recession. Good investors make money in recessions all the time. And I don't have the exact figure. Maybe, Mike, you could Google. But if you check out how much money Warren Buffett made the week after the market crashed in 2008, and I forget the number, but it's several billion dollars. It's a stupid number. And when you realize, that's how real investing happens and that's how smart people invest their money, as soon as it crashes in 2008, Buffett's out there wheeling and dealing, making billions of dollars the next week when the market opens up.
So, WallStreetJournal.com states between the months of September and October 2008, he exceeded $15 billion that Berkshire Investments made.
So from September to October? Okay. So check this out. If you didn't hear Mike, so Mike said from September 2008 to October 2008, Warren Buffett made over $15 billion, right?
And he turned down financial lifelines to buy out from struggling companies to do the buyouts. He even turned down companies.
Yeah, he turned down Lehman. Lehman came to his door asking for money, and Buffett said no. He let them bleed. So you look at, that's a big number. That's $15 billion. So those of you that are like, oh, you can't make money in a recession, guys, Buffett, $15 billion. $15 billion. That is a lot of, most of us will never see 1 billion. The dude made 15 of those in a month. That's a killer amount of wealth. Branson's 4 billion. Mm-hmm. He quadrupled Branson's net worth 4 times over in a 30-day period. Think about how substantial that is. That's ridiculous. So these are the 5 we've had, guys. And I want to dive into these. I'm going to go into detail and we're going to kind of look at what happened during these. I want to start with what happened. What was the result of what happened? And what were the actual losses in each of these recessions? Now, the most recent one was 2008. Okay, we all remember 2008. I think I was in 10th grade. I remember sitting in, move this way. I remember sitting in class hearing people talk about how their parents had lost, slope jobs and different stuff like that. But it didn't hit Alaska hard. To be honest, like 2008 wasn't rough up here. Mike, where were you in 2008? Ohio?
That was pretty bad.
Pretty bad down there. Nano with Texas?
Didn't even feel a thing.
Okay. So we didn't really either up here. So that just goes to show economic macro recession. Some of those micro areas, Texas wasn't really hit too bad. Alaska wasn't really hit too bad. Ohio was. Okay. So basically in 2008, we went over this, summarized it last week. Banks were doing interest-only mortgages and introductory rate mortgages to broke people. Okay, they didn't have to prove their income. People weren't even filling out loan applications all the way. Like they were just partially filling them out, and they would be able to get mortgage after mortgage after mortgage after mortgage. There was a story in the book, The Big Short, they talked about, and in the movie, they didn't do a good job of this at all. When they went to Vegas, they went to one of the conventions. There was actually a stripper who had 5 homes. Think about that. Like that's not smart. Like the lender on that scenario, you could tell he was just trying to earn a commission, right? And you can't even verify income. It's all cash. So you look at 5 homes, right? So people had just home after home after home. And what was happening is they get the primary, then they would get extended a home equity line of finance, a second line of credit on the mortgage. They'd borrow against it, get another one, and just continue to repeat that process. So all of them were based on credit. Now the banks would take these loans and they would sell them. They would sell them to firms on Wall Street. And the Wall Street firms would package them up in CDOs and CMOs and then basically pay off the rating agencies, collateralized debt obligations and collateralized mortgage obligations. And so basically they would pay off the rating agencies to put them as A-rated, so investment grade. And so like bond companies, mutual funds, they would buy their investment grade bonds and not inspect the underlying holdings to see that there were toxic mortgages in there that were repackaged up, right? And so ultimately, when somebody sells debt, the person that sells it gets a cash influx. So people would sell this toxic debt for a bunch of money, pass the buck down until the final person ended up holding it, which was usually going to be a firm or a mutual fund or an investor, somebody that was, ultimately going to buy and hold that asset. Okay, now think about, you guys ever played that game Jenga where you pull the little things out from the bottom? Okay, that's what was happening is one guy would default, there's a block out. Another guy would default, there's a block out. Another guy would default, there's a block out. And these consumers started defaulting on all of their mortgages, right? And if they're defaulting on their mortgages, it means they're no longer paying the bank, which means the bank can't any longer pay the firm that bought the debt, which means the firm that bought the debt can't pay the people they sold it to. And it just goes down the line on all of these defaults, right? Now, that was really kind of the underneath the recession. And most people didn't want to see that coming. Most of the firms were only looking at assets under management. So they just wanted Mike's money. They would just sell Mike whatever they could, these crappy mortgage bonds, because they could earn assets under management and they would earn a percentage of those assets under management, or they would earn a commission on the sale. So it's Wall Street greed at its finest is really what caused the 2008 recession. And basically, these companies ended up going insolvent. To understand, a lot of these companies, while they were stacking up these mortgages, they were also selling what's called a credit default swap. A credit default swap is basically like insurance on the loan defaulting. So if Lexi was the bank, right, and I was the borrower, I would do a mortgage with Lexi, and then Lexi would take out insurance on my mortgage so that if I default, Lexi still gets paid. So the companies had these credit default swaps. There was probably 5 or 6 different groups that saw the numbers. They saw the mortgages. They saw people were defaulting. They started buying credit default swaps from these firms on a discount and just basically sitting on them and waiting for these mortgages to default so that they would get the payouts. So when you look at The Big Short, that movie and the book, you can see the main characters in the book, the main characters in the movie, those were real people. And that's what they did is they bought these credit default swaps so that they could basically get the payout on them. And they made billions of dollars off the crash doing that. So check this out. The loans defaulted at a rapid rate, causing market defaults. And that basically, that hits everybody, right? So if people stop paying their mortgage, they lose their house. Okay, if they lose their house, that's a big part of their life. People stop showing up for work. Companies are going under. Financial firms are crashing. Banks are going under. Like imagine having more like a legit mortgage you've actually been paying on and having the bank call you up and say, hey, Nano, I know we agreed to this, but we need you to pay your mortgage off now. You'd be like, bro, like I don't have $300,000. I don't know what to tell you. And then they foreclose and kick Nano out of the house. That's the kind of stuff that was happening even to the good borrowers because the banks were financially insolvent at that point. Okay, we're talking giant companies. We're talking Merrill Lynch. Did you guys know Merrill Lynch wasn't always owned by Bank of America? They used to be their own firm. They had to sell to Bank of America because Merrill Lynch was about to go under. Okay, AIG had to get bailed out. Okay, Lehman Brothers did get bailed out. So that's what happened in 2008. Now, this was just 11 years ago, and we act like nothing as bad could happen again. 11 years ago. Now, check this out. This is one that amazed me. 2002. Okay, and it's hard to hit this in sequence because it actually happened kind of all at once. 2002, I call this part 3 of the tech bubble. Okay, so the tech bubble started in the late 90s, early 2000s, and that ran for 3 years straight where the market was down 3 years in a row. And that doesn't happen often, but this did happen in that case. So this was a combination of a couple things. So we had a bunch of tech companies that came out, internet companies that were basically just brands and domain names with some sales, but they were overvalued because the internet was new and there's a bunch of hype. So your price earning ratios were whack. Okay, companies were priced way beyond what their earnings could actually justify. So you have overpriced tech companies, several companies that went bankrupt at that time that were high rollers. They had a great reputation. All of a sudden they go bankrupt. The market's going to respond negatively. And then on the tail end of that, you're also recovering from 9/11. So think about that. You have tech companies that people are betting on. You have like pets.com, world.com, all of these like giant online companies that are going under. You got financial firms going broke, and then you have terrorists attacking the World Trade Center, all within like a 2 to 3 year span of time. Okay, the markets got wrecked. And again, it's going to be your correlating assets. Your home, that went down. Your 401k went down. And your stocks went down. Nano's wondering why people invest in the 401k. I know. I mean, you know, it's fees. That's the only reason. And then you have 2001. This was kind of part 2 of the tech bubble, right? So 2001, you have the interim. It's in the middle of the tech bubble. So think about the tech bubble just happens and the market's already trying to recover, and then you throw a terrorist attack in there. That's what happened in 2001. So the market went down again in 2001. And what that translated to with investors is more and more losses. So think about like in 2000, right? You're an investor and you're abiding by the aforementioned rules of, oh, it'll come back up. Just wait it out. It's going to be okay. And you're waiting in 2000 and a year goes by and then it goes down again. And then another year goes by, and then it goes down again. 3 years in a row. Mike, how would you be feeling as an investor if you were following just wait?
I'd be upset. I'm like, I need something to happen.
Super upset. Okay, if we look at like some of these market periods, and you guys are going to see my secret app that I like to use here. So if we look at some of these periods here, I'm going to show you guys some of the rolling periods where the recessions actually happened. And you're going to be amazed. The reason why you can't quit your day job is because you can't retire based on the numbers. Okay, we're going to look at economic calculators. And let's go to the S&P 500. So this is going to show us indexed returns on the S&P 500. And I want to show you guys some of these rolling periods we're talking about with recessions. So let's look at 2000 through 2003. Let's see what you would have done during that period of time. Okay, so
Can you tilt the iPad so it's in a bigger? There we go.
So your total return annualized for that 3-year period was negative 10.4%. So those of you that are like, oh, my 401k is up this year. Like I talked to a guy today. He's like, yeah, man. And he actually moved his 401k over. He's like, yeah, man, I did 12% last year, but I know it's not real and I know it's not going to last. He remembers the year he had negative 10.4. So if it went up 12, that means it can go down 12 as well. Okay. If we look at just since, let's say then till now, let's see what that looks like. Okay, so even since 2000, you've only averaged a positive 6.79% return gross on the S&P with no volatility, no fees. Assuming you had no fees and assuming you didn't lose money, you didn't pull money out. Okay, over 20 years, Nano, is that worthwhile for you as a return?
Absolutely not.
Absolutely not. So this is the kind of stuff you guys have to look at. You can't just be like, oh, my 401k went up. Like, what about when it doesn't? Like if you justify your decision based on it's up this year, then logically speaking, you would do the same behavior when it's down and say, oh, well, it's down this year. Maybe I should pull it out. So if you justify leaving it in by saying, oh, well, it's up this year, then you should also justify taking it out by saying, well, oh, it's down this year. The reason you don't is because you don't know what to do when it does go down. So check this out. The other one I want to hit here, this is 1990. So we actually went about 10 years until a recession happened. Okay, that's quite a long wait, especially looking at, we had one 3 years in a row and then 6 years. The next one we waited for is now, right? The next recession that's going to happen. So in the 1990s, and this was before I was born, but if you look back at it, so this was actually a deflationary period, okay? Meaning that the Fed was worried about interest rates rising or inflation rising, so they brought interest rates up. You guys probably can look back and recall when, 70s, 80s, 90s, rates really started to climb in the early 90s, the late 80s. And so the Fed was trying to fight off inflation by raising rates, and they actually created a deflationary period where the market started to stagnate. Okay, spending started going down. We started to go into a recession in the early 90s. So we have that going on. The Fed restricted monetary policy, just like we talked about at the beginning of today's segment. Rather than just letting the market supply and demand sort itself out, they reached in and said, we better make money more expensive. Okay, so if I make interest rates 18%, Mike, what's the incentive for you to borrow? It's not there. Okay, so, and it's not based on Mike's credit, it's based on the economy. So if it's a vacuum and Mike and Nano are going to do a deal and Mike's got good credit, Nano's going to give Mike a good rate because in that transaction, it makes sense. But if I bring market rates up so that Mike is, regardless of credit, going to pay 17%, even if Mike is a good spender and a good borrower, he's not going to do it. So now production starts to go down because people are worried about spending money. It's too expensive, right? It becomes scarce. Now, not only that, we were already in a sluggish environment. We had oil tanking in that same period. So oil prices started to really drop. Consumers lost confidence there. We were finishing off the Cold War, okay, with Mother Russia. And then we had a third of our savings and loan institutions go broke. Okay, in the late 80s, about a third of the existing savings and loan institutions went financially insolvent. They disappeared. So think about that. That causes a recession. And so again, the market dipped at that time. Now, I'm of the belief that because of that deflationary period in the early 90s, that's why we waited so long to have another one in 2000s. Okay, in 1997, 1998, that's when they released like the Roth IRA. They brought the traditional IRA back in. They started releasing the college IRA. And that was all an effort on the government's part to start to increase and lubricate spending again. Let's give tax incentives. Let's get people saving. Let's get people investing, because people were still recovering from that slow roll in the 90s because the rates were so high. Okay, so these are all five. 1, 2, 3, 4, 5. These are all 5 recessions that we had. Okay, the last 5. Now, if you're watching this today, I want you to ask yourself, what was the financial condition you were left in after 2008? Okay, did you lose money? And if you lost money, what behaviors were you doing financially that caused you to lose money? Were you putting a bunch of money in your home? Were you matching the 401k? Were you riding on the retirement plan? Were you not saving? Were you staying out of real estate? Were you not trying to become an entrepreneur? Those are all things that contributed to you being vulnerable so that you got knocked over in the recession. And if that is what you're doing today, when the next one comes up, it's going to happen again. And here's the deal. This is going to sting a little bit, okay? When you lost the money, you didn't lose it. It went to somebody else. Somebody smarter and more prepared than you got the value out of your home. Somebody smarter and more prepared than you got the value out of your 401k. So the money that you lost was not lost. It simply transferred hands. And you've got to really be able to confront the fact that somebody was smarter and somebody was more prepared and somebody did make money off your loss. Okay, not everyone lost money. Now, if we want to live in that world, then it's okay and everyone loses money and recessions just happen. But in real life, like they do happen, they're caused, and people make money on them at your expense if you're the one that lost money. Okay, Nana, you had a question?
Mike, are we handling questions now or is it then?
Let's kind of save those for the end.
Okay.
Yeah. Now, we're going to go into the big four here. So I'm going to talk to you about the sacred account because this is the only account that I can find and the only investment that I can find that has not lost money in a single recession. Okay. No matter what recession we look at, it made money, which is incredible. So we have Guardian. That's one of the companies we work with. Guardian has been around for quite some time, and Guardian has paid a dividend since 1868. Guys, that's 151 years in a row. Year after year after year after year. That means that they went through the Great Depression. It means that they went through the 1950s. It means they went through the late 70s. They went through the 90s. They went through 2001, 2002, 2003. They went through 2008, and they still made money every single year. Think about that. So when you're like, man, like, and sometimes you can watch this stuff and feel overwhelmed. Anyone ever done that where you watch a program on like investing or like, recessions and you just feel like less equipped? You're like, I'm severely unprepared. I don't know what to do. And I feel dumber than when I started watching it. Guys, this is not a complex strategy. You set up a life insurance policy with us. We structure it with high early cash value. You put it on autopilot where every month you contribute to it and it just sits there and makes money. And it's done that 151 years in a row. That's super consistent. Like I literally cannot show you a bank that's done that. I cannot show you real estate that's done that. I cannot show you a market investment that's done that. I cannot show you a stock that's done that. Gold and silver haven't even done that. And the US dollar sure hasn't hella done it because it goes down every single year. So maybe the dollar could be like that, but it's just opposite where it lost money every single year. Okay. But my point is that there literally is not a more stable, consistent investment out there. And if you can prove that to me that I'm wrong, like what should I do? $100?
Sure.
If you can show me something that is done, and let's pick on New York Life since they're the longest. If you can show me something that has made money on paper, real, 165 years in a row and has never lost money ever at all in that same period of time, I'll give you $100. Okay, you won't find one. So that's Guardian. Mass Mutual, that's another one we work with. They've paid dividends since 1869, so for 150 years in a row. That's a century and a half. New York Life, they've been around they've paid dividends since 1854. That's 165 years in a row. Like, think about the consistency there, guys. Like, that is a sure thing as if I've ever seen one. Okay, my point here is in a recession, you do not have to have a complex strategy. It's cool if you have one and it's great if you know this stuff, but if you don't, like, do something that's simple and works. If it's simple and it works, it's accessible. You're doing something that's simple and doesn't work. And it's really not that simple. It's just the fact that right now you don't actually understand what you do with your money. It just seems simple because of just basically naivety is what it is. It's ignorance is bliss. So it's not that simple. If you look at a 401k and you realize that you don't just put money in a 401k, there's funds, and those funds are part of sectors, and those sectors are part of holdings, and those holdings have micro holdings of stocks, and there's managers, and there's turnover, and there's fees, and there's standard deviations, and there's all this stuff. It's not that simple. This is, you stick money in the account, it pays you a 6 to 8% dividend based on the company's profitability. It's done that for 165 years in a row. It's never not done that, and it's always done that. Like, that's the bottom line of the deal, right? And then finally, we have Northwestern Mutual. They've paid dividends since 1871 for 148 years in a row. Okay, and my point here is, guys, again, it is super simple. The goal is to A, not lose money, B, still not lose money, and C, make money every single year no matter what. And if you can do that, you have compounding interest and you are recession proof. But if you're in something that goes down, which is your home equity, your 401k, your dollar, your cash in the bank, then you're going to lose money in a recession. Like there's no black or there's no gray area. There's black and white, period. And the thing that people, let me grab a sip of water here. The thing that people do that amazes me is I talk to these guys that have, $50,000, $100,000, $200,000 just sitting in the bank, and they're not leaving it in the bank because they're preparing for an opportunity. They're leaving it in the bank because they're afraid. They're terrified. They have 200 grand sitting in a checking account or a savings account or a money market, and they're afraid to do what usually, Nano?
Put it to work.
Afraid to put it to work, but why? They're afraid to lose money. And they don't realize by doing that, you are guaranteeing you will lose money. Every single year, you're losing money. Just because it didn't happen in one big wallop in the market doesn't mean it's not death by 1,000 cuts. Okay, a boat doesn't usually sink because a hole was blown in it all at once. It sinks because it leaked and leaked and leaked and leaked and leaked until it wasn't salvageable and it went down. So you've got to really look at, am I airtight when a recession happens? Where am I keeping my money right now? Am I growing it? Am I in something that's historically never lost money? Okay, and this isn't like some hypothetical of based on if it existed in the past, it wouldn't have lost money. We're saying it did exist. It was there in 1854 making money, and it has ever since. So that's huge to realize. Now, a couple things I want to go over here. If we look at, these are the dividend rates for the companies we work with. So I'm going to just single out a couple of these. We have Mass Mutual, 2018, right? We've got Mass Mutual. We have New York Life, Guardian, Northwestern. All right, so check this out. If we go back to all the recessions, 2008. In 2008, you would have made, with our top one, you would have made 7.9% in 2008. Tax-free. Okay, most people in 2008, on average, they lost about 37%. 37%. Now, check this out, Nano. Look at this. So you've got, in 2007, you only made 7.5. So in 2008, you actually did better. So how would you like to be positioned in something that when a recession happens, you earn more money? That's called an inversely correlating asset. That's what we talked about last time. In 2000, here's what you would have made. Okay, you would have made almost 9% in 2000. Okay, most people in 2000 lost money. 2001, same deal. You held your ground. 2002, you would have actually stepped up a little bit on this guy. New York went down a little bit. Guardian went down a little bit. And Northwestern went down a little bit, but you still were right around 7%, right? And those are things you've really got to consider. If we go down to the 90s, in the 90s, you would have made 10 to 11%. Okay, this is why we don't work with Ohio. They don't provide their numbers. Okay, but you would have made 10 or 11%. Now, those don't seem like giant numbers, but when you realize that you would have made that return, check this out. You would have made that return, right? So let's say it was 10 and a half. I could have borrowed against my account, did a real estate deal that paid me 12, and still also made the 10. Okay, Nano, I have a really hard question for you. What's 12 plus 10 and a half?
22 and a half.
So if I earned 10 and a half over here and 12 over there, what did I earn? 22.5% in a down year, in a recession. That's what we're telling you. So you've got to look at, like, are there better strategies out there? Now, you haven't heard about this, and the reason why is your financial advisor doesn't get paid fees to sell it. He doesn't even know about it. I literally sit down with people that sell life insurance, and they don't even know this exists. Okay, we've had people that work for life insurance agencies see how we do it, ask their agency to do it, and their agency is like, I don't know what that is. I don't know how to do that. What are you talking about? So check this out. This is a head-to-head comparison. All right, Mike, I have a series of very hard questions for you. These are difficult. In 2008, you ready?
Okay.
You prepared? You might want to limber up a little bit. Just stretch. There you go. There you go. So in 2008, would you rather negative 37% or positive 7.9?
Positive 7.9.
Are you sure?
Sure.
Okay. In 2002, would you rather a negative 22% or a positive 8.05?
Positive 8.05.
Are you positive? Okay. In 2001, would you rather a negative 11.9 or a positive 8.5?
Positive 8.5.
Are you sure, sir?
Yep.
Okay. Some dangerous decisions you're making. In 2000, would you rather a negative 9.1 or a positive 8.5?
Positive 8.5.
You're positive of that as well.
Yep.
Okay. And the last question, in 1990, I know you weren't born yet, but would you rather a negative 3.1 or a positive 11?
Positive 11.
See, Mike was negative 3 years old at that point in time. Mike was negative 3 years old in 1990, and even he knows that 11 is better than negative 3. Some of y'all, though, you're going with the negative 3 because the year before it looked good. Okay, that's no different than like biting into an apple with the razor blade, and then you keep going after you bite the razor blade. Like, just because it looked like an apple at one point doesn't mean you need to keep eating it. Okay, if it's cutting you up and destroying your finances, don't keep biting it. That's not a good idea. Okay, so I wanted to give this comparison because it really does show in every single recession, we have made money with the sacred account. In every single depression, we have made money with the sacred account. There's no other asset that's done that. The market hasn't done that. Real estate hasn't done that. Gold and silver haven't done that. Cash hasn't done that. And if you want to be recession proof, you need to be looking at strategies like this. Okay, so I'm going to open up for questions in just a minute here. I want to give you guys some action steps. So action steps, if you are watching this tonight, number one, if you want to keep money out of loss, put it into non-correlating assets. So if you want it to just stay put, you don't want it to budge down or up with the market, you want it completely uninvolved, I want you to have that money in non-correlating assets. Okay, a non-correlating asset, one of the ones we offer, it's called a life settlement investment. Lexi, you were looking at some of those today. What were you telling me about, like the returns on like a 5-ish year period?
It's anywhere between like 15 to 20%.
So Lexi was shopping life settlement policies today, and she was seeing 15 to 20% annual returns in these accounts that are not tied to the market. Okay, but if the market crashed, it would still pay out because it's based on a death benefit, not a stock market. Okay, so that's a non-correlating asset. If you want money that is going to inversely correlate with the market, meaning it's going to go backwards. If the market goes down, it's going to go up. One of the ones that we offer is called gold and silver bullion. I'm going to pick on Lexi again. Lexi, you bought gold a year ago. How much money have you made on that 1 ounce you bought a year ago?
A little over $200.
Okay, a little over $200. In percentages, Lexi has made, we particularly picked out this 1 ounce she had 8 months ago. She's made 27% on it in the last 8 months. Okay, so the market's been moving down and it's been more turbulent. She's making money in gold right now. Okay, and this is stuff that you guys can easily do with us. It's simple, and it's a lot more simple than your 401k is. Number 3, drop funds into your sacred account first so that you can lock in the dividend growth before you invest your money. This is huge. If you realize if you tag money to the sacred account first, then it's going to earn dividends forever no matter what. Why would you not tag every single dollar you had into the account before you invested it to lock in that dividend rate on the money? And then finally, stay out of the market and stay out of residential home equity. Okay, there's no reason why you need to be trying to pay off your house right now. There's no reason why you need to be putting more money into the 401k plan. Like, all of that stuff is rigged against you in a recession. Okay, so that's what I have for you tonight. I do want to open up for some questions. Do we have any questions here in the room today?
We do. Eric Whitaker asked, will the recent tariff battle between the U.S. and China expedite this overdue recession?
I think it will. And again, this is speculative, Eric, but I think it will. Anytime we have turbulent trade with a major player like that, and I know they're saying we can go to Mexico and other countries, but I do think that that's going to end up resulting in a recession. And bottom line is, and this is not on the news, people are not talking about this, countries like China are selling U.S. treasuries right now to exchange them for gold. So like, if they're getting rid of our debt, it means they know we're broke. Do you really think they care if we stop trading? No, like, they're already betting on the fact that we're insolvent and they're stacking up on gold instead. So I think that's more of an attention grabber than anything. Ultimately, we're going to be in a recession anyways. I think that probably will speed it up though.
We got one from Daniel Chusa. What kind of rate do you think gold and silver will be when the recession hits?
Man, that one is hard to predict, Dan. So, so I have a buddy that I was talking to. He had silver in prior to 2008. He bought silver. He bought 3,000 rounds of it. Okay, and he paid $6 per ounce. So he bought 3,000 1-ounce rounds of silver. He paid $6 per ounce. So you do the math on that. That's 18,000. And then after 2008 hit, silver went up to 50 an ounce, and he sold it at 50. So he had 3,000 ounces now at 50. So that's 150 grand. So he took 18 grand and turned it into 150 grand. And that's the kind of upswings. That's the kind of upswings we see. I believe in the last one we saw, and you guys could maybe check on this, but I think gold went from maybe 600 an ounce up to 1,200 an ounce. So you're seeing some big returns. You're looking at doubling, tripling, quadrupling, because what happens is while we're in a boom, gold and silver are really low, because it's something that people aren't really riding on. There's not a lot of demand for it. In a recession, when things tank, people start buying it up because they know it's a stable value store, and it drives the pricing up. And so you see these giant booms. And the idea is to do cycle investing where I buy the gold and silver in a good time and I wait on it, kind of like the credit default swaps, right? It wasn't sexy or attractive, but I know the crash is coming. I'm going to wait on it. And as soon as the crash happens, I'm going to convert my ounces back to dollars. I'll go buy all the assets that are now on sale.
There's a question here on Instagram. Junior Clark is asking, how long do you think it is going to last?
The recession or the period until the recession? What do you think he means?
I think the recession.
The recession? Man, it's hard to say. At least 6 months. Mike's a smart ass. At least 6 months, Clark. By definition, it has to, right? It's hard to say, Clark. So the last one, when we had 2008, that lasted, maybe all of 6-9 months. It really depends on how involved the Federal Reserve gets, and also if it's even effective at that point. So in the last recession, we really did ourselves in with the amount of money we printed, and we also really did ourselves in with how long we held interest rates down low. That still hasn't resolved itself. So when the next one snaps, that strategy can only work so long before we just destroy our currency. So that's a good question. I don't know the answer to that. That's speculative. And I think that we're in a very tight position where the Fed has to really watch their back on their monetary policy when the next recession does hit because of the damage they did in the last one.
Here's a good one from Todd Bugoli. What clues are you seeing in today's economy that is indicating we are near a recession, just tech bubble, housing market, etc., other than it's been 11 years since our last recession and we appear overdue?
Yeah, so Todd, that's a good question. And there's a video I'll send you later on. So first one is we have an inverted yield curve, and that's been an indicator, literally like clockwork. Almost every single time we've had an inverted yield curve, there's been a recession. And what that means is that the rates on long-term bonds are dropping. Okay, so I saw an article the other day that said Australia just released a 100-year bond that's paying only 2%. They're locking in a 2% interest rate at 100 years. Denmark right now has negative interest rates by 0.50. So imagine putting your money in a bank in Denmark and having to pay them negative 0.5% to store your money there. Or inversely, borrowing money from them and getting paid 0.50% to borrow their money. That's how tight Denmark is right now. So that's the first one I see is this is an inverted yield curve. So anytime that's happened, Todd, a recession follows almost like clockwork. The other one that happened recently is the Dow Jones did what's called a triple top. And a triple top means that the market went up, it peaked, it dropped, it peaked again, it dropped, and it peaked again a third time and then dropped again. Anytime this has happened, it's also been followed by a recession. Okay, the Schiller Case Index, I think it's called the Case 20. It measures the 20 largest metropolitan cities in America. We're seeing housing, which was kind of up and then it was flat. Housing is finally going down. Okay, and so we're seeing housing going down in the largest metropolitan cities in America right now. We're also seeing railroad transport going down. And this one I saw in macro. I talked to a client the other day who actually drives truck. He's in an area where they do a lot of that. So macro, we're seeing railroad transporters going down. He said that in his industry, he's seeing freight trucks on sale like crazy. Like people are getting rid of freight trucks. And what that means is that freight trucks are traveling less and less. There's less of a demand because supplies aren't really going back and forth as much. Okay, one of my good buddies, Matt Monero, he owns a company called Commercial Fleet Financing. And so that's what they do is they do financing on freight trucks. And he said the amount of financing they're seeing is dropping because people aren't doing as much transport right now, which means goods and services aren't being exported from one business to another or from business to consumer as much. So that's another one. One of the big indicators that we're seeing as well is with small businesses, we're seeing cash flow statistics dropping and debt usage statistics going up. So businesses are making less money and cash flow is going down, but they're borrowing more and more money, which shows they're not profitable. The last PE report on the market with larger companies, these are your publicly traded companies, that was a very low price earnings report. So that's another bigger one. And I mean, I could keep going on these all day, but those are the main ones. And there's several others, but I can send you a video to check out later on, Todd. But those are the main ones. And I would say the ones that concern me the most is really the freight. Like even Warren Buffett, he says invest in railroads because that's one of the ones that's predictable. Like that's one of the ones that also shows you when a recession is going to happen and when it's not. How much are goods and services going back and forth right now? So those are some of the hard indicators to answer your question, Todd.
Kind of like the quote that Warren Buffett talks about when everybody else is, they're spending money and they're like excited. Oh, what the heck?
He says you need to stay inside with the doors locked.
Yeah, basically stay locked up, and then when everybody else is scarce, you need to go buy everything.
Yeah.
One of the indicators, like the Todd was asking about, I think it affects the middle class the most, and the lower middle class is that Fed rates drop for homes, right? So every realtor I know is like, buy a home now. It's the lowest it's ever been, right? Because the rates are going to go back up. That's a bad indicator because everybody's going to buy the homes and then they're going to default.
Right.
And I think that's just horrible. Like obviously that's going to happen, but
yeah. And that's a good point to bring up. What Mike is saying is every time the Fed lowers interest rates, it's not like someone hit the piñata and candy fell out and we should all celebrate and buy homes. That means the Federal Reserve realizes our economy is in a bad position and they're lowering the interest rates to try and stimulate the economy and keep it from crashing. Now, the reason why that's important is with that inverted yield, it means that they have done the lowering of interest rates. They have done that for such a long period of time that our 30-year rates, our 100-year rates, if you're Australia, they're negative right now. Like our 30-year rates are low right now. So they're dropping so low because the Fed is not predicting that the economy is going to improve for Australia even in the next 100 years. Like that's just straight up apathy. Like to realize like, oh, we're screwed for 100 years. Let's keep our rates that low on that long term of a bond. You don't even know if they're going to be a country in 100 years. So those are all things to look at. And another one too, and this one I was telling Lexi about this. I was like appalled when I heard this. Have you guys heard of the company WeWork? WeWork, they do like commercial office space leasing. So it's kind of like communal office space leasing. So they're raising, I believe it's a $50 billion IPO. So check this out. WeWork, so they have office spaces and they lease those out as community office space, kind of like the boardroom kind of a situation downtown, right? Now they're raising $50 billion. They don't own any real estate. Those are all leases they signed. So they're basically subletting space to other people. They've got no assets. They've got nothing other than leased contracts, and they're going to raise $50 billion off of it. That's the kind of stuff that crashed us in 2000 with the tech bubble, was companies that were basically shells. They had nothing. It was hype. It was branding. They raised a bunch of money. There was nothing back in it. So like imagine us, grabbing this 3,000 square foot office space on a lease, subleasing it to Nano for more money than we leased it for, and then raising money from investors to fund that and calling it a business. Mike, would you invest? Hell no. You'd be like, what? Where's the business? Like I could go do the same thing, right? So like we're seeing that stuff happen too inside the market. So companies like that are coming in, and again, overvalued, under earning. That also causes crashes in addition to some of the stuff we mentioned already here.
Todd asked if the market is showing triple top pattern, should one be interested in taking bearish positions in the market? I know you don't really like the market, but if it's almost a sure thing.
Todd, you could. I would call that a gamble rather than taking bearish positions in the market. Buffett talks about this. So he talks about rather than trying to find like He relates it to cigars, trying to find cigar butts and finding a little tiny nub and trying to smoke whatever's left of it. He says, just go buy an excellent cigar. So I don't want to look at discount prices on items I wouldn't even buy if they were on sale right now. And if I wouldn't buy them on a premium because I don't like them, I wouldn't buy them if they were on sale. So you've really got to look at like what type of asset do you want to own? And if the answer is not stocks, I wouldn't try and play the game of let's catch it while it's down and ride it while it goes up. The reason Buffett does that is A, he's buying controlling interests. So he's buying enough money where he actually has some say in the company. He's not just, buying little bits of it. And then B, he wants to own those businesses. So I don't want to own like a couple shares of Apple if it crashed, because Apple's not an investment I would want to have. I'd rather have real estate, bullion, sacred accounts, things that I actually love, because I understand them and I know they're going to produce no matter what. So that's more of an investment philosophy question. I think that is speculative. Yes, it's going to go down. Doesn't mean the one that you buy is going to come back up with it. You look at stocks like Citi, like they never really recovered after 2008. And it doesn't mean that the one you picked would recover. So you've got to really play your cards well on that. Any other questions?
Todd says, got it. Thanks, Jerry. And Team Wealth Dynamics, great content as always.
No problem. Thank you, Todd. Oh, guys, so Nano wants me to give a shout out to our Google page. If you're watching tonight, we helped you. We gave you information that was worth your time tonight. Go to our Google page, Wealth Dynamics, just on Google. Leave us a review. We've got, I think, 75, 76 reviews. We're trying to get to 100. So if we gave you information tonight for free that helped you, make sure you leave us a review. Make sure you like the video, you share, and tune in again next week. We'll be back again next Friday, same time. We appreciate you all, and we'll talk to you soon.